Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we are taking a look at VICI Properties Incorporated, ticker VICI. It's been a year since we last took a look at it. Last year we came up with a fair value of $40, and now I'm coming up with a fair value almost $49. And the price of the stock, so it looks like they've gone up not even a full dollar on average per share. So I do think that there's some room to go. They are still undervalued. Last year, our projections were annual growth of about 8%. It looks like, at least with the thesis we're coming up with here, it's down a little, well, down a bit from there. But fundamentally, 7.9% earnings yield, really good. We'd be willing for earnings to drop to 1.61 for what we're buying. And what we're seeing is 2.62 expected this year, 2.73 the following. Earnings yield is great. Cash flow yield, 60.3 on average, 66.5. Again, great numbers. Dividend yield, 5.28 on average, 4.5. Payout ratio of almost 65%. So they should be paying a higher dividend out this year unless they're going to issue more shares. And it's kind of how they operate, is they're able to hold the dividend pretty steady, get reasonable growth out of it, but issue shares and use that to buy more assets or pay down the liabilities that they currently have, which they seem to be really good at, because ROE almost 10%. That's what we like to see. Debt to equity 0.73. So the ROE is legit here. We'd expect to see a pretty high debt to equity for a real estate stock, and it's really good. So I really have no complaints about anything fundamentally here. ROI is a little low, under 5%. ROA 5.7. Margins are super strong, both gross and net, and that's all because they buy properties and they rent them out, and that's how they operate. So for our thesis here, we're trying to come up with a reasonable case first. Analysts are projecting about 5.8% revenue growth this year, 4% next year. So 4.8, kind of in between those two. It'd put revenue up to 4.5 in 5 years, when currently it's sitting at 3.9. So that's definitely reasonable, especially at the rate that it has been growing. Share count growth of 4%, kind of slowing down a little bit off of what we've seen, hopefully. And again, that's no surprise here. I don't really blame them for it. If they're able to buy properties, pay down their liabilities, and not harm the shareholders, it's a win-win. And they seem to be really good at that, unlike some other companies. Cash flow growth, 4.3%, not quite in line with the revenues because, well, actually, let's put it in line with the revenues then. Kind of hold the current yield that they have. And then assets, they're really good at growing their assets, but their liabilities grow faster. So that's something that we need to keep an eye on. They have a really good balance sheet. It could get worse. Dividend, 5% growth seems pretty reasonable. That puts you at a yield on cost of 6.7% if you buy now in 5 years. And then margins, I feel like could say hold flat and it'll be good. So what we're looking at with that thesis is an average annual growth rate of about 5%. And then once you factor the dividend in on top of that, we're talking 10%. So you're beating out the market. So if you're buying at today's price of $32, you're going to see some nice outperformance. I mean, the fair value in 3 years is about 52, and in 5 years is about 55. But with this being such a balance sheet heavy company, we can factor that into the valuation. Most companies, it doesn't affect it too bad. But if we add liabilities and subtract out cash, saying you're buying this company outright, you have to pay off those liabilities, and you get some cash to help you with it. What you're actually looking at is a current share price of about $49, which is right about at the fair value. So I'd say right now is a reasonable price, but if it climbs up too much higher, then it's not going to be as reasonable, because you need to factor in that extra $17 per share that is coming from the liabilities. Financials look super strong, just consistent growth here. The gross profit, net profit, and EBIT all look pretty good. I mean, net was pretty flat up through 2022 and then jumped up in 23. Balance sheet, we hope to see a lot of assets, nice tangible and growing. And the tangible book value looks great. I mean, they have more tangible assets than they have debt, which is really good. This is a balance sheet that I love. Cash flow's looking super strong. A little wonky there, 2020, 2021, but that growth from 22 to 23 is great. And if they can continue that, then things will be awesome. The dividend, there was a pullback in 21, but if they can get back on track, things will be looking great. Their dividend is dependent on their earnings per share. Ideally, it's pretty consistent, but I mean, 2020 and 2021 was a different time for a lot of companies. And then we come to the valuations. So, of course, the balance sheet leads everything. I mean, this is a balance sheet heavy industry and company, but everything else moves pretty tight down in here. And the actual share price is lagging everything else. The dividend bringing in the lowest value currently, and then the earnings, and then the cash flows, the fair value, and the balance sheet. So that fair value is really being driven up by that balance sheet. It looks like on the lower end, 37 would be a pretty good price to get into it. And on the higher end, 45, which I agree with. So somewhere in that range, 37 to 45 would be a really fair range to get into it. Below that is really good, like today's price. So now we can go back to the summary. And is there anything that we can change with all this? Maybe we grow this up to 5% growth. Share count. Actually, let's do a worst case scenario here now. Now that we saw reasonable, I mean, best case, reasonables are already really good. So worst case scenario, the lowest that we see is 4% growth. Share count, what if they come back again with 18%? That's probably going to hurt investors quite a bit. That wipes out about 3% of returns right there. Cash flows, what have we seen on the lower end? Cash flow growth. We saw a 20% drop in the last year. Let's put negative 19% there. Oof, that takes their cash flow yield down to 17%. Definitely not what I think is going to happen, but this is a worst case scenario. Assets, they only grow them at 16%, okay. Liabilities, if they grow that at 50%. The dividend, 5% is lower than what we've seen. Margins, hold steady, that's fine. What we're looking at then is underperforming the market in 5 years, just barely. Still great in the 3-year. Your average returns are negative, but you're starting out at such a deep discount to the fair value that things are fine. And this is a medium cap stock. I mean, their market cap is only $33 billion. I've seen other companies do more than that in revenue. So nothing crazy here. I mean, they haven't even surpassed $4 billion in revenue yet. So it is a pretty small company and just doesn't have a lot of eyes and money. And that's where I've been trying to look to try and find some opportunities for future growth. And this looks like it's one of those with potential. I mean, you're going to get outperformance of the market and you've got a discount to the fair value. So it's definitely something that I'm interested in. I do own some, and I wouldn't really mind buying more if it dips below like $30. If it were to go back down, I mean, if you look at the range here, it's gone as low as 26.5 and as high as 34. So it doesn't move a whole lot. And if it were to go down below 30, I would buy 100 shares in an instant. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. I'll catch you next time.